Hi, everyone, and welcome to the Goblin Hideout, the NFT Finance Podcast. I'm Terry, and today I'm joined by my co-host Ryan. And today we're speaking with Jake, the founder of Hook Protocol.
Hey, Jake.
Hi, how's it going?
Good. I think to kick it off, maybe you can give a quick background of yourself and what you were doing before crypto, how you got into crypto. Just a general intro would be great.
Yeah, absolutely. So I actually kind of come from more of the art and art tech side of things into NFTs. I was working on a company, or I was actually working on Hook originally, when we were focused on making it easier for people to buy and sell art online and also do some financialization with art. And what I mean by art is not digital art, but like kind of paintings that you hang on the wall, which is kind of a really, really, really old market that doesn't have very much technology. And basically what happened is, we saw a huge lift in kind of online art sales during COVID. But we were also watching kind of the NFT summer happen last year, and a lot of the people that we were most excited about working with from the art world began to organically adopt NFTs, which made us think, maybe this is actually where we should be spending our time. And as we dove in, there was just more and more use cases that emerged and more like clear market needs. And we decided, ultimately, kind of sometime in January, February, to fully pivot the company and focus entirely on NFTs. And I guess, what might be interesting to your audience is the kind of financial aspects of NFTs.
Yeah, that's awesome. And then I know we've talked before, but your family is also involved in art. Is that right?
Yeah, so my mom in particular is really involved in kind of public art and nonprofits in Texas and Houston. So she kind of was formally trained as a curator and worked as a curator. Now is more involved on like museum boards and things like that. But I kind of have been lucky enough to be immersed in it and kind of going to museums, meeting artists, talking to collectors for basically my whole life, and that's what initially got me into art as a concept. And I was particularly fascinated, perhaps a bit more than my mom, with the market for art, versus just the art itself.
No, that's awesome, and I would imagine it's been like an influence on the creation of Hook as well to some degree. So maybe we can talk about just the high level of, maybe you can provide the high level example, like Alice and Bob example of how Hook Protocol works.
Yeah, absolutely. So let me maybe step back a second and maybe say more directly what it is. We're basically building a kind of NFT native call option protocol. And what we mean by NFT native is we want it to be really easy to use for someone who doesn't understand a lot of DeFi concepts, like maybe a price oracle or kind of fractionalization and ERC20s and things like that. So basically a regular NFT user to basically be able to create and buy or sell a call option. So the way that plays out in the protocol is that individual deposits an NFT, the writer, let's say Alice, I guess, deposits the NFT into the protocol with a specific strike price, and they get another NFT minted back to their wallet. They can sell that second NFT in a regular sale to, say, Bob, and that could happen either on our marketplace or a marketplace like OpenSea, if they prefer, wherever there's liquidity for it, and then earning a premium. At the expiration of the option, the underlying asset that Alice had deposited in, like say her punk or whatever, gets auctioned off by the protocol. And if any person, either Alice, Bob, or a third party, decides to bid more than that original strike price that had been specified at the beginning of the option, then the strike price will go to Alice. Bob will get the difference between that high bid and the strike price, and then the high bidder just buys the NFT essentially from the protocol.
Awesome.
And basically, the kind of key point being that there's just two sales of NFTs, which, most people who are really interested in NFTs, whether or not they come from a DeFi background, kind of fundamentally understand.
So curious, why is the option like Vault kind of structured as a smart contract wallet? What were some of the like positives of maybe doing this?
Yeah, I mean, there's kind of like a class of problems when you're vaulting asset beyond the smart contract risk, where you want to be able to kind of preserve whatever utility those assets have. This is really challenging, like in the ETH case, because a lot of what you really want to do is deposit into like a lending protocol or something like that. That will kind of make that ETH earn yield while it's vaulted. But in the NFT case, most of the kind of quote unquote utility is more like claiming airdrop or being able to, potentially authenticate to a Discord or participate in something like Noun's governance. And by structuring the vault as a smart contract, where we allow you to interact with other contracts, either by flash loaning it out or in certain restricted cases, actually sending transactions from it, almost like a multi-sig, the writer can kind of retain the utility of their NFT and basically, still effectively own it, while while the option buyer knows that it's kind of secure collateral for the option.
Yeah, and you mentioned like a flash loan in there. How does the flash loan like process work, and then why would someone want to use that?
Yeah, so take an example of a noun. Say you have a lot of nouns that are deposited into the Hook protocol, and they're all kind of serving as underlying assets that options have been written on over, let's say, like a really long period of time, like 2 months. And then say there's like at the same time some really malicious Noun's government proposal that is being voted on. If these assets were like traditionally vaulted, like say into some type of lending protocol, for example, it might be really difficult, it might be really difficult to kind of defeat that governance proposal, and then a malicious actor could come in and and basically like say drain the Noun's treasury. But that might be attractive to someone. But by having this flash loan mechanism, we would allow those holders to essentially securely inside the context of one block, borrow the asset that they actually own from the vault, do something like vote on chain using their wallet that holds that asset to kind of defeat that proposal. And then as long as they transfer it back into the vault prior to the end of the block or the end of the transaction, the vault itself still acknowledges that they own it, and there's no problem in terms of like eliminating the collateral for the underlying asset, for the option.
One thing I'm curious about in regards to the flash loan process is it seems that it's intuitive, that it's something that people want. I think Paradigm has a public utility that anyone can use to extract NFTs out of the NFTX vault. Why is it that it hasn't been done yet? Like, what are the traditional blockers to it? Is it perhaps gas intensiveness?
I would actually say the biggest blocker is like implementation complexity. I don't know about you guys, but I'm now reasonably experienced writing Solidity. But if I had, let's say a $500,000 asset, I might get a little bit skittish about, deploying a flash loan, that I just kind of casually write, and then, having it do something that's kind of completely unaudited, where I might risk, somehow losing my asset. This is a little bit lower risk, of course, in the sense that, the vault is, designed to prevent the asset from like changing owner. But I think there's just kind of a general skittishness of people like not wanting to write the code, to touch it. So from my perspective, one of the things that we're trying to do is actually kind of basically provide canned implementations of like certain common things, in kind of the contract form where you can interact with the interface, on our website, instead of having to like write custom code that, calls the Vault smart contract to basically accomplish the same thing. So for example, if that hypothetical Noun's proposal, did emerge and we had a lot of Noun's in the protocol, we would very likely essentially write that smart contract and potentially even have it audited, or at least do a community audit on those holders' behalf to, make it easier for them to utilize this. We're also experimenting with things like literally creating like a Wallet Connect client where you can, essentially Wallet Connect to the Vault contract execute an individual transaction, using the vault as your wallet or as if it were your wallet, and then just paying the additional gas to do it, which would make it really, really simple to interact with some of these protocols.
Got it. That makes a lot of sense. So I guess at the end of the day, that you guys might develop even like a gauntlet of tools that allows you to, like flash loan and then do things depending on like how the users want to use their NFTs while they're locked in the vault.
Yeah, exactly. I mean, our goal is basically to the extent that the NFTs have utility, make sure that utility is preserved when it's in the vault, because that, in a way kind of reduces like the cost of posting it as collateral, where otherwise you would have some opportunity cost of losing that utility.
Got it. That's absolutely fascinating, because we've been looking at a lot of, uncollateralized lending or renting solutions, and that has been the traditional blocker. Having access to the utility of the NFT while it's in a vault. But yeah, like that poses a sort of like fourth solution that this is, I think, our first time interacting with a protocol that's using this.
Yeah, there was another one I think called Bend Protocol that you all might be familiar with. That's really related to a lot of the borrowing that has implementation that's similar to this. And of course, NFTX that you mentioned. There's been a lot of really interesting use cases with NFTX of kind of claiming airdrops with NFTs. But again, that's a kind of fundamentally different protocol, because you don't have, or because you're not having a claim to a really specific NFT. You really kind of have a generic claim to a pool, or the pool kind of in that case might just earn a fee from giving other people the utility for the NFTs that it owns.
Right, got it. Yeah, that makes sense. The other thing I wanted to ask about was when you were describing the initial protocol, you mentioned the sale of two NFTs, principally the options NFT that, the sale price would signify the premium of the options that you write, and then later on the underlying asset, which would determine the strike. I'm curious why you decided to use the auction mechanism, because my understanding is that there would be some trade-offs, namely that the options writer wouldn't get to decide their premium, and then later on, depending on the auction duration and the market conditions during the auction duration, you would get different outcomes in terms of settlement. Could you perhaps remark on why you made the design decision? What are the pros and cons of the design decision, and how you guys balance those out?
Yeah, so I think that the most interesting piece of it is really the design decision to use an auction at settlement versus, say, requiring physical settlement. And what it basically boils down to is, we don't think that the market today is sufficiently developed such that there will be many market makers who want to kind of buy back these options from option holders at close to fair market value, pay the cash to physically settle the NFT option by basically exercising it, and then subsequently selling it on OpenSea or another marketplace. And what we wanted to do was kind of allow people buying options to get exactly what they wanted, which was kind of these upside economics of owning an NFT, and then allow the sellers to kind of get exactly what they want, or the writers rather to get exactly what they want, which is the premiums that they would earn. So in particular, we actually did two things with the auction mechanism that kind of benefit those writers. One being that if no bid is in excess of the strike price, they automatically kind of retain the underlying asset and can write another option on it. And then the second is that if there is a bid that is outstanding above the high strike price, above the strike price. So if that NFT is going to be sold, the auction writer and only the auction writer is able to make another bid using just the ETH that would be the spread, because after the auction, they would end up, basically getting back the strike price anyway. So it just kind of mitigates that. And that's a way that they can kind of protect their asset. That someone like the option writer or a third party would require a lot of ETH to do.
So you mentioned that basically once the bid kind of exceeds the reserve price, the piece essentially is sold, and then I guess so the option itself is an NFT, correct? Is that
right?
So okay, interesting. So was that correct? Is essentially in saying that like once the bid exceeds the reserve price, it's sold off?
It will be sold. So it's the kind of the final price, it's not the first bid above the strike. It's the highest bid at expiration, as long as there is a bid above the strike.
Okay, understood. Yeah, no, that. It's kind of fascinating. And then I know you mentioned in some of like the documentation that there's a 24-hour time window that triggers that auction, but it's on a per collection basis. Is that what kind of determines that?
Yeah, so we actually think that 24 hours is probably about right. However, there are some collections, especially really, really, really newly minted collections, where it may be the case that you want shorter duration options, say perhaps an option of 2 days, right? And then in that case, it may not make sense to have such a long auction period at the end. And instead, you would want, like a 6-hour one, right? And then there's the kind of the opposite case where it might just be the convention of certain markets. Like you could see this happening in markets where people have where people want to hold like beyond the short-term capital gains cliff in the US. Where option durations might be a year, for example, and then you might want to have like a week-long auction period at the end, just to kind of give people more time to do the settlement auction. In reality, our expectation is that most of the bids are going to end up happening just like really close to the expiration, because people want to basically set the price on the last day. And most of the markets that we think it's going to be feasible to write options are already liquid enough where you're seeing multiple transactions happen, inside it, say a time frame like a day.
One thing I want to ask about, going back to our original conversation about like the option writer's relationship to the bids, what are the other choices that the option writer has in terms of being able to choose the range of bids that they want, being able to choose the range of premiums that they want? Because as someone who's like dealing with a portfolio of loans, we want to hedge in a way that's more precise, right? We want to make sure that the premiums we get and the strike price that we write at are sort of exactly where they want to be. But the auction mechanism kind of prevents this. But I understand that there are a lot of guardrails that you placed. Could you elaborate more on what they are?
Sure. So the premium is at least, or I guess there's kind of a couple pieces there. So the auction for the option NFT, is totally kind of dependent on what the writer wants. So, for example, if you were to sell that option NFT on OpenSea, you could just list it, against their liquidity. If there were any, say, whole collection bids, for a particular price, and that's actually pretty close to how it will also look within our order book. So, our kind of goal is to help the writer kind of understand where there actually is liquidity for the options inside the market in terms of strike price and in terms of potential premium, to the point that, once we have a lot of people that are listing different options at different strike prices for a given collection, we may be able to show that the options expiring next Friday at a, say, 65 ETH strike. And if this is let's say you're in, some collection that's trading today at 40 ETH, have kind of a floor price today of, let's say 3 ETH or 4 ETH. And then that, for kind of a person who's really used to selling NFTs, they basically look at that and they're saying, well, I'm minting an NFT, with these parameters, basically 65 ETH strike and expiration of next week. And I know what the floor price is, and I can decide, do I want to list an option at that floor, or do I want to go to a lower strike price that, is in another bucket, let's say the 50 ETH strike, that might have a significantly higher floor and list there.
Got it. That is extremely fascinating. Actually, on that note, I want to ask something new that we've been seeing around NFT finance is the emergence of financial NFTs, UniV3, LP positions, Goldfinch, you guys, Nifty 5 promissory notes, etc. And then
Squeeth is another interesting one.
Yeah, Squeeth. There are a lot of examples, and I guess I'm really interested in the interplay between NFT finance protocols and these financial NFTs. What do you think about the space? What do you see here in the future, like like pseudo swap bonding curves for different strike prices. Just like the design space seems to be pretty large, but just wondering what your thesis is here.
Yeah, I mean, I think a big piece of our thesis of why you would want to, own a lot of liquidity in NFT options is basically, hoping that some set of NFTs that are in effect cash flow producing, those may start out as more financial things. It may, move to being more like real world assets or, kind of hybrid real world on-chain assets that, are cash flow producing, begin to exist, because ultimately those types of assets are much more easy to value on the valuation side, and in some cases, like in the case of like a Uniswap LP position, can actually be immediately redeemed for a certain amount of like highly liquid asset, which is actually right now kind of the most common case of financial entities. So our expectation is that these are going to proliferate. And one of the reasons that we're so bullish on options versus, doing like a floor perp or, something of that nature, is that that entire class of financial NFTs are, I guess I would say, like much, much, much harder to make an oracle for, where it's already, a bit cumbersome to do like an oracle for any NFT collection. The financial NFTs are like intrinsically truly non-fungible, even if they happen to be made by the same contract. So you actually need kind of financial structures that, in a way, respect the kind of individuality of an NFT. Like you're never going to like realistically start dumping, Uni V3 positions into an NFTX pool, because it's just like what's the benefit of doing that there? But you could conceivably see options on something like that.
On the note that you just mentioned, the limitations of certain financial NFTs and regarding the oracle problem, et cetera, I'm kind of curious. What's your opinion on real assets on chain? They suffer most largely from the problem that you mentioned: oracles, centralization of a legal force, restructuring in the case of liquidations, et cetera. Would you say that financial NFTs and NFT finance, like, does it have a chance to come up alongside these real world assets, which are then tokenized on chain and using these protocols? Or would you see the development more so as like crypto native NFTs, crypto native financial instruments that then use NFT finance, and this industry develops in that direction?
Yeah, I actually think the NFT finance is going to be one of the main reasons that real world assets actually end up on chain. So, if you think about it abstractly, like most of the stuff that exists in the world around us is basically owned by someone, or assignable is really what we mean by it. A lot of them are just like contracts that have cash flows associated with them that are assignable to someone, and are really, really, really expensive to transact. So NFTs have like a base benefit that there's like, basically it like solves high transaction costs and maybe like creates more liquidity. But as soon as you add like, these other potential benefits, like, we have liquidity available on an options market that you can stand up really quickly, in the same way that you can create like a uni pool for like a random token pair, you could create an options market for a particular type of real world asset. That's actually super, super, super powerful, because there's tons of real world assets that may not have enough financial sophistication in the real world that actually for the first time could have that exist like in a really robust way on chain. And then those real world assets actually have a particular advantage compared to the crypto assets, where their ability to basically be fairly priced is not limited by the amount of liquidity that exists for them on chain, but in fact can tap into like real world liquidity as well. So if you take the real estate market, the real estate market in the US is bigger than by like NAV, bigger than all of crypto, right? And if you can basically, let's say, like, take the classic NFT as real estate example, if you can say you can both sell this NFT on chain to another buyer, or you can actually sell the underlying asset that it's wrapping on, the New York real estate market, you actually have a much, much, much larger pool of liquidity and a much clearer view of like what the fair value is, because you're not limited to what's actually happening on chain today.
Yeah, absolutely agree on those points, actually. But I guess like I'm kind of curious to see how you think about, right? Like one great thing about real world assets on chain, like times NFT finance, is that they will be able to access global liquidity. And as soon as you bring something on chain, then suddenly it has access to every single financial instrument under the sun without anyone ever having to make a market for it, anyone ever having to, right? Like anyone ever having to spin up like the market infrastructure for it. My bad, not make a market. But the arguments against it largely have been the fact that it relies on, legacy legal rails to catch up in recognizing like the NFT's position as either a legal claim, and then the centralization force of legal recourse and restructuring deals, liquidation. How would that be like a large impediment to, real world assets ex NFT finance?
I mean, I think it is. You don't see very many real world assets being traded as NFTs today. But so I agree with you that it is an impediment. I just think that it's a solvable problem. And, ultimately, the great thing about, I think, the structures that will work is that I think the NFTs will kind of trade separately from like an entity that actually holds a real world asset. So like, again, going back to the real estate example, you may create an LLC that holds the real estate that isn't, actually transferring the title of that every time an NFT is transferred. Then the NFT, transfers frequently on chain. And then when that, when it comes to the day that you need the liquidity and you want to basically redeem the NFT for the real world asset, that's the only time that you KYC, and that's the only time that you, actually pay the, associated transfer taxes in some cases, or whatever the transaction costs are. So yes, the NFT then should trade at some discount that, is meaningful to the real world asset, but you're basically paying kind of a liquidity premium as the buyer, or rather as the seller of that asset, of that NFT asset, to basically, be able to plug into these financial rails. We actually have kind of a friend of ours at Slow Ventures who's working on like a really interesting structure for this. They're actually using they're actually on Solana, but they're using fungible tokens, to accomplish this with a piece of real estate that I think they were telling me maybe they don't want to announce it yet, but they're buying soon. And they already have the funding in place for it, that basically they're, hopefully going to eventually open source the docs that they've used to accomplish exactly this. And I think, their assets will, significantly transcend, just real estate that you can have in that structure. Like, one of the things that I'm really interested in as a, native Texan is, mineral rights. I think are like a pretty fun one to have on chain, because they're kind of very cash flow producing, especially in markets like today's. And then there are all these assets that are kind of interesting, like LP positions in venture funds or in hedge funds that make a lot of sense on chain. And then there's kind of like the real crypto native version of them that also is emergent of like a fully smart contract powered, venture fund, for example, that seems like really promising, where you could, have all of those LP positions or various tranches of payouts represented as NFTs as well.
So I don't want to completely, shift away from the conversation, but and this is probably for offline, but I spent like 5-6 years in energy. So the mineral rights comment definitely like made my ears go up. So, and fully agree kind of with that. I guess to bring it back to Hook, maybe you can talk about the kind of like the instrument metadata, like what's the vision with the metadata, and also what's really the purpose of the nonce?
Yeah, totally. So, those are two really good questions, actually. I guess maybe the first thing I'll say is like it's kind of tied back to who we're building this for. So I think a lot of like the NFT DeFi founders are basically going with the thesis of like, something that we've talked a lot about, actually, and I agree with, of let's bring financial sophistication, and more assets are going to come in, and then most of the assets that actually exist will be kind of represented as NFTs, because of the liquidity rails or whatever that they can plug into. And I think that's true, but we're also trying to solve like a really specific problem that we've seen emerge in kind of the recent PFP craze. And that's basically for this trade-off of having increased liquidity and much easier transferability, or for this benefit, you actually pay in having higher volatility because it's very attractive for speculators. And one of the things that options, at least theoretically accomplish if you can have like a large options market, is essentially moving that kind of active trader volume that is actually driving the volatility in the market for an NFT to a side market where the active traders can participate. They get better capital efficiency. They might maybe get better returns, and then they essentially pay in the form of premiums the long-term holders, for the right to use their assets this way, and also hopefully move some of the volatility out of the market. So we think that like as a kind of a problem to be solved in NFTs is actually really important, not just for the PFPs today, but also in the long term. And I think one of the important things as you try to solve a problem like that is you want to be really native to the kind of needs of those traders. So one of the things is people actually like having cool looking NFTs in their wallets, like whether it's on Rainbow or whether it's on OpenSea itself. And essentially what we're trying to do is kind of get to a point where we can actually upgrade separate from the option contract, this kind of NFT metadata. So you can have like a really immersive experience, like with a HTML or SVG on the OpenSea page, to kind of use a slider to see what the payoff of this particular NFT, of this option NFT might be, but then also maybe see like the underlying asset inside it, or do a bunch of stuff kind of along those lines, which should be really exciting for people who are just really like trading NFTs, basically.
That's cool. And then maybe this kind of plays into it a little bit, but you did in some of your documentation, you mentioned extending like the functionality of the protocol in the future, specifically with kind of like derivatives markets based on a like same single token. Maybe you can speak to that a little bit.
Yeah, definitely. So, today and honestly for the foreseeable future, we're really focused on these kind of call option markets. We think calls in particular are, the right thing. But as you have liquidity grow inside that, you have this really interesting thing that happens, which is you actually kind of develop a price oracle for the assets in a certain collection. Basically, that is every single week, we might have a certain number of options expiring. That all kind of have an implied valuation for that underlying asset. And you actually get a really accurate oracle, especially, with respect to one problem, which is when liquidity drops inside a collection, because you're actually forcibly auctioning off, these assets, even if they don't necessarily successfully sell. So we think that kind of using that data, which by the way exists on chain, is like kind of a really promising area for future building kind of additional types of derivatives products, whether that's a perp or whether that's like a synthetic put option or something like that. One of the things we're kind of waiting for is actually kind of for other protocols to solve the kind of capital efficiency problem. Like right now, it's just like not compelling to put a bunch of ETH into a put contract, let's say, and have it sit there as collateral. And we're basically hoping that someone will come up with like a really good kind of cross-protocol, cross-margining type solution. Maybe using some combination of dark pools or, some combination of, some extension of like a lending protocol where, we'll be able to have these positions that maybe will be liquidatable because they're synthetic and at like a really clear, basically value and price. And then we'll be able to utilize that kind of cross protocol, margin pool to be much more capital efficient, which I think would help a lot with making puts and things like that more attractive. Because today, if you really want to write a put, you would actually come to you guys and just like borrow some money against your NFT.
Yeah, and everything you just said, besides the last part about cross-protocol capital efficiency, that is sort of a taste of what we're working internally at Goldman Sachs. So yeah, that was pretty prescient there.
I'm glad. Yeah, I think like a lot of people that we talk to come to us and say, we want to get puts because we want to like basically hedge or something. I always ask them, well, you can literally like, on a lot of the assets that they're asking about, at least you can actually pretty cheaply, not that cheaply, but kind of cheaply borrow money against them. And, they kind of say, well, it's too expensive. And my thinking is, well, the reason it's expensive is because this is like the market price for a put option is actually quite high. It's like nobody wants to kind of sell that insurance, so to speak. So you have to, pay pretty dearly for it. And I think, the kind of like, lending position is actually just like a much better solution for kind of the broad array of uses that people have for being kind of like net short on their NFTs.
Yeah, 100%. Exactly how we think about it at Goldman Sachs. I guess the differentiator is that our settlement layer is Nifty Fi, but instead of having the option premium up front, we suffer the consequence of like the Nifty Fi settlement layer, which requires the option premium, the APR of the loan, if you will, to be paid at expiry, which does complicate a lot of our analytics and our math. But
because what happens if the loan defaults and you don't get paid?
Exactly, like what happens in the negative equity case. So we combine like a series of insurance models and option pricing models to make sure we manage our risk. But as you said, hedging has been a perennial issue for us as well.
Yeah, definitely.
And I guess like probably getting close to closing it out. So maybe you can talk kind of, and I know we've kind of like skirted around this throughout the entire conversation, but if you could like concisely say really what your thesis is on NFT finance as a whole, and really just maybe a few points of why you're so bullish on the space.
Yeah, I would say, that's I actually don't have like a broad thesis on it as a whole. I think I kind of have more of a patchwork, but maybe I would go back to and say like what our focus is we think that there are problems that are really pressing for the current kind of creators and holders of NFTs in today's market, namely this kind of speculative volatility problem that can be meaningfully solved through finance. And we believe that if we successfully solve that and successfully get liquidity in kind of this protocol of options, the kind of downstream applications are also very large and very juicy and kind of beneficial.
Awesome. And for any of our listeners, Jake, what's kind of the best way to stay up to date on what's going on with Hook, and is there any way for them to get involved?
Yeah, totally. So we actually, we haven't launched the protocol yet. I should mention that right now our protocol is in audit, and we're really excited to kind of release it, in a real way to the public soon. We do have a Twitter account that's not very active, which is @HookProtocol. And I think right after, well, probably by the time this podcast airs, let's say, we'll have a Discord open and, a lot of activity on there, and hopefully with a kind of end of summer launch.
Beautiful. Yeah, we'll make sure to put a link in when that's up. And yeah, it was really great chatting with you, and really appreciate it. Everyone, please go check out Hook Protocol. It's been a pleasure, Jake.
Thanks, Joe.
Follow me on Twitter. I'm 0xTayTayHoho on Twitter. That's Tay with an E. And you can follow Ryan @_Helmass.
Yeah, and that's _HELMASS. Thanks everyone for tuning in, and we'll catch you soon.